Okay, so what we're going to look at today is some differences in FHA versus conventional. Now, FHA loans you're probably used to seeing on a house like this, a brand new house. And they've been used on also over across the street over here like a townhouse. But they also can be used on several other things. And one of the things we're going to look at are duplexes and fourplexes, which are really a fantastic way to go if you're buying your first house. A big plus with FHA, it allows you to get a loan with credit scores all the way down to 500. Now, between 500 and 579, you do have to put 10% down. But after that, at 580, you can put down as little as 3.5%. And on top of that, you can also get a down payment assistance program so that you can basically get in that house with zero down out of pocket. With FHA, they give you up to 6% of closing costs that can be paid by the seller, which is a big plus because if you get the down payment assistance to go with that loan, you can basically get in that house with zero down. It's not the best thing to do. I always think it's important for you to have some skin in the game. But if it's the difference between you getting in a house or not getting in a house and you can't get in that down payment assistance program, it's a great way to go. So let's kind of look at this example here. First of all, we've got a house that's priced at $400,000, and what's happening is the seller is going to give them $15,000 towards their closing costs. So with this way of going and using this program, this allows the person to actually get in with zero down. Now with conventional, it's a little bit different. With a conventional, yes, you can get a gift, but it's a lot harder to qualify. One of the main things is that conventional, you need at least a 620 credit score. And with the 620 credit score, you're probably going to get a much worse rate than what you would with FHA. That's one thing that's wonderful about FHA. It's going to give you a much better rate, even though your credit score may not be perfect. So you can go 3% down, and then also with the conventional, there are some additional piggyback programs you can go on to, but it's a little bit tougher to get than what it is with FHA. So FHA is still my favorite if you're a first-time home buyer. Now, another thing that what conventional also does is they have mortgage insurance, just like FHA. Even though FHA still has mortgage insurance, they have two types. The first one is a normal monthly payment mortgage insurance, just like you would with a conventional loan. However, it also has a second type of mortgage insurance, and it's an upfront mortgage insurance. And that usually gets added to the back of the loan. So it actually makes your loan amount higher, and then you pay it off over the course of the term of the loan. The good news is usually because of credit score issues, FHA loans, the mortgage insurance on that, the monthly payment is going to be significantly lower than it is on a conventional one. A thing about that's really good about conventional loans, however, is that the mortgage insurance usually drops off when you've paid that house down by 20%. So once you're at an 80% loan to value on that house, that mortgage insurance will just drop off naturally. Where in FHA, unless you're putting 10% down, that 30-year fixed rate has mortgage insurance the entire way through. Another thing that's great about FHA, it allows you to go up to 57% debt to income ratio. And what that is wonderful about, because if you don't have perfect credit, this is a big plus. Because not only can you put the house and your house payment in there, and that total has to be no more than 47%, but the back end ratio is 57%. And that 57% is not only the cost of your house payment plus your taxes, your insurance, your mortgage insurance, and any HOA fees that you have, but it also includes things like car loans and credit card bills. So you put all those in, and if that's more than 57% of your total income, gross income, that's before taxes and insurance comes out, then technically that should be approved by an FHA lender. Okay, but one thing you do have to be concerned about any type of lender is that all lenders kind of have overlays on them. And that means FHA comes with its own set of rules, and then what happens is the lender may have an overlay over top for their specific rules. And if they put 2 or 3 overlays over it, then it might make it a little bit more difficult for you to get that loan through that lender. So what you want to do is you want to talk to your lender and find out a lender that does not have too many overlays on it, because that could significantly help your chances of getting approved on an FHA loan. Okay, let's go look at another house. In 2025, FHA has changed their loan amounts in order to help people qualify. They've raised them up again. Here's what the numbers, what they look like now, compared to what they were last year. In addition, they've also done some major changes on the way they actually process FHA loans to make them quicker and easier to get completed. Finally, what they've done is they've given you greater flexibility for your student loan payment when it's considered on your debt to income calculations. And what I mean by this is simply that they used to, when you had a credit report, when you review it, By what I mean is this, is when they used to look at your credit report and you showed a student loan on there, but it showed no payment necessary on there, they used to hit you for 1 full percent. Now what they do is they'll use the actual payment, or they'll use only a 0.5%. So that means that if you have $100,000 in student loans, now they're only going to hit you for $500 on your debt to income calculation versus the full 1%, which would have been $1,000. So that's a huge bonus. When we're looking at a fourplex like this, as you can see, there's 4 units here, which certainly allows people to be able to finance this. What's great about this is you could live in one of the units and then you could rent out the other 3. And so by doing this, this will be able to help you as far as to gain wealth over the course of time. Now, there is one thing that they do differently in financing these versus a single family or a duplex home. When they use a single family and duplex home, you're being able to use the income as far as that you're getting from the second part of the house to help you qualify. Well, that's a great way of being able to do that, because let's say if the house payment is $2,000 and you're getting $1,000 towards rent on that property, then what happens is they have a formulation that give you roughly 3/4 of that. So they'll give you 75% or $750 to help you qualify for that particular house, which is a great way of being able to do it. So you could actually buy the house, live in one half of it, and then use that rent, and then eventually get enough equity out of that place, and then do an equity loan against that, and then use that equity to buy your next property. And that's one way that a lot of people gain wealth over the course of years. The key is, once again, is to be able to find the right house ahead of time and be ready to buy it. So to get together with your loan officer before at all even putting an offer. So make sure you do that ahead of time. Now let's talk about these, for example. When you're buying a triplex or a fourplex, there's a specific program that they have to look at in order to do that. And what that is called is a self-sufficiency test. A self-sufficiency test is just simply this. They're going to look at the amount of income that comes from that specific fourplex. And so if you're getting $1,000 out of this one, $1,000 out of this one, and $1,000 out of that one, that's $3,000 a month. So what they do need to look at is to make sure that the income of that $3,000 actually is enough or higher than the amount of the principal, interest, taxes, insurance that are due on that particular unit. So we're going to look at 2 examples here on these same units. So let's say this costs $500,000 to buy, and you put a down payment of only $17,500. The interest rate is 7%. So that means your loan amount is $490, $943 when you put in everything in for your FHA mortgage insurance premium. So when you look at that, your total monthly payment with taxes, insurance, and mortgage insurance and is going to be $3,887.40 a month. Now what we use is, let's say that you're getting $4,500 a month for your rental, and we use a vacancy factor of 0.75%. So that means that we're going to use a total income of $3,375 of net rental income each month. So if you look in this factor, does it qualify? No, it doesn't. And the reason why is the total monthly payment of $3,887 is more than the $3,375 of income that you're generating. So let's say now, for example, that you're able to look at the same example, but you're able to get $5,200 a month. In this scenario, you look over here, your net rental income, which again is your $5,200 of your total rent times the vacancy factor of 0.75, is equal to $3,900. So that number is higher than the monthly payment at $3,887, and therefore you're going to get a big thumbs up. We're outside of a house right now. It's a duplex, and this is one thing you do have to look for, is that there's a lot of homes that won't qualify for FHA financing because of the home itself. Now this is a duplex here. There's 1 and 2, and this gentleman here just purchased this house, and he spent $500,000 on this house, and you can see the issues. Up here you can see areas where it's not even painted. You can see wires hanging out over here, and you can see areas over here where the paint is peeling right here. None of this is going to be qualified for FHA financing. On the roof itself, it needs a new roof. You can see areas that the roof is popping up. You can see pine needles on the roof. So those are other big issues. When you look inside the house, if you look inside this house, you'll see parts of the house, I don't know if you can see that, parts of the house needs fixing. So when people are buying an FHA house, for example, they are buying a house. FHA is considered buying the house so that it's ready to live in. And if that house isn't ready to live in, then it's not financeable. The back of the house looks pretty good, but once again, you can see issues all with the roofing of the house. Before I get to the final tips, I just want to say, if you do find this helpful, please hit that like button and subscribe to the channel. Final tips today, here's what you want to do for sure. Number one, find a local lender. Don't use one that's completely in a different part of the country unless they know your area. If they know your area, that's great, but they need to know the local programs. They need to know if there's down payment assistance programs that are available and how they work. A lot of times, only the local lenders are approved for some of these down payment assistance programs. Two, get a copy of your credit report. Go over that credit report with your lender or by yourself early on, 6 months before you even apply for a loan, maybe 3 months if you feel like you've got pretty good credit. That will give you the time you need in order to fix any small things that are hurting your credit, and therefore a better credit score means better interest rates. Okay. Finally, take a home buyer class. They're cheap, or a lot of times they're free. They go over some basic information that you need to know, and then by getting that information now versus wait till later, then you'll be able to understand things as you're going through with your lender, with your realtor, with your insurance agent. It'll make the whole process go a lot easier for you, and you'll be able to feel the freedom that it is to be a home buyer. All right, everybody, thanks for showing up today. I appreciate your time. We'll see you again. Have a great day.